So I'm talking about prep equity. Preferred equity is a financial instrument used to build leverage real estate capital stacks, which kind of straddles the line between debt and equity. So as far as the pro forma goes, it acts kind of like mezzanine debt, but it has equity structuring and equity like behavior. So like I said, you can get higher returns than senior debt with prep equity, but it has lower risk than common equity. So it sits between the senior debt and the common equity in a typical capital stack. Now it's similar to, in our structuring, we usually have a dual class structure with A1, A2 shares. So it's very similar to the A1 shares in that you get a fixed return. But the main difference is in prep equity, this is typically more for institutional level investments. The prep equity shop can retain control rights, which means that if something were to happen, they can step in and take over the property, and also default remedies. So if the property is facing foreclosure or distress, the prep equity can step in and save the deal. So that's another main difference compared to just the A1 shares in a dual class structure. So like I mentioned earlier, it's similar to mezzanine debt, but in mezzanine debt, it's a debt instrument, so you typically don't get the same tax benefits as equity in a multifamily syndication. So prep equity tends to have a lot better tax benefits because essentially you get the same tax benefits as the common equity. And so if you have accelerated depreciation via cost seg study, you also participate in that as the prep equity. So here's a sample capital stack. So say your senior debt will typically give you up to 75% LTV. So if you look at a lot of the agency debt, 75 is like the max. So typically your DSCR will constrain you to something like 70, 72. So prep equity, its purpose is to really fill in that gap, to get you to where you want as your overall equity. And so typically a lot of prep equity shops will allow you to go up to 85% LTC. So you can cover the some of the rehab costs as well. So it works particularly well for value add deals. And then the last part is the common equity, which is the remaining 15% of the LTC. So as you can see, incorporating a pretty big CapEx budget into a value add project, like the deals that we typically do, you would be able to come in with a lot lower equity required if you brought prep equity in as to fill in this gap to get you up to 85% LTC. And of course, the higher the LTC, the higher the risk, but at the same time, you also get outsized returns if there's a value add component and you can actually execute on those assumptions. So another benefit of prep equity is you get downside protection. So let's say a sample deal of 10 million, the prep equity could give you say up to 80% LTV. And so from the prep equity perspective, if the senior debt is 70% LTV, so 7 million, and the prep equity brings in $1 million, their last dollar basis is 8 million. So they're really protected from that remaining last dollar basis up to the 8 million. So like if say something were to happen to the deal and now you have to sell it for less, you can still sell it down to 8 million and still be protected from the prep equity perspective. And there's some unique opportunities in this current market with prep equity, which one is rescue financing. So for distressed deals that are facing foreclosure and they ran out of forbearance or whatever, prep equity can step in and give you that rescue financing so you don't go through foreclosure. And another one that we've been dealing with a lot is COVID reserves. A lot of the agency lenders are now requiring COVID reserves from 9 to 12 months of PI. So now the prep equity can step in and provide short-term gap funding so that you can restore that LTV back to that 75 LTV that you normally would expect.
Duke, what what would be a reason we would do pref equity versus just raise the rest? Like why would we go to a prep equity firm? I know we were talking about this once we got off that call, and like what was kind of the things that we were thinking aside from the COVID reserves, because that was obviously our number one, and I'll talk about that in a second. But and on a normal world, where would prep equity fit in versus just our regular A1, A2, or just anybody else that's looking to do deals like this? Like when would they flip to their Rolodex to a prep equity firm? What would be a
Also,
good
so typically it's when you can't get that LTV that you want to achieve the IR that you're targeting. Because obviously the higher the LTV, the higher the IRR typically. So if you can't get that financing up to the LTV you want, then that's when you would bring in prep equity. But another benefit is that it's a single sophisticated investor versus a whole group of investors like in a typical syndication. So let's say you had that 15% LTC yourself, like in your own bank account, like you can take down a deal with just one other partner with the prep equity shop versus having to syndicate it and go through all that process of SEC requirements.
Yep. And that was one of the ones that, we saw was, so for both of the example, you can't get LTV requirements. And this is happening so much lately where you get like the bait and switch from a lender, right? And we got it on our last deal. We ended up switching banks and rescuing that deal to close. But so they get in the door, they do an application, say, oh, we can do 80% LTV all day. We do these, $50 million of loans a year. No problem. We got it. And then you waste a month and a half with them, go through underwriting, they go to committee and they come back and be like, oh, sorry, it was a fluke. For some reason, they're only going to do 65%, right? LTV. And that's happened to us. So it's your options are go back out of the deal because you're short like $200,000 or whatever, $300,000, $400,000. Go back to your investors and try to raise the additional funds, which is going to tank your IRR, like you said. Or you can reach out to one of these prep equity companies like this and get some kind of like a mezzanine debt structure. So, well, you have mezzanine debt, and then you can do prep equity. The difference between the two is, mezzanine debt has to be allowed by the lender, right? Because essentially a second position, and some lenders won't allow that. They won't allow a second position. Or prep equity, they're an equity player. They won't be classed as debt, like Duke was saying. So that's like one big scenario where a firm like this would come in, is if the debt came or the LTV came in much lower. And that was an example of that. And the COVID reserves. And for those on the call, like don't know, like can't really put like a number to that. For example, the debt service on one of the deals that we're going to do is was like $14,000 a month, right? So that's our debt service on the deal. If they require 12 months of reserves upfront impounded in an account, that means we have to raise another additional $168,000. So not only do we have to raise it, but we have to raise this money, put it into an account that we don't have access to for an entire year, and that money's not working for us. So it's just dead, like dead equity. It's not working. It's not getting a return on it. It's just sitting in an account for an entire year. And what that's going to do, that's going to push your returns down for that project as well. It not only does the challenge of having to raise that additional funds an issue, but then also what raising those funds does to the deal. If you can raise them, it's going to reduce your returns as well. So it's overall a pretty crappy deal killer, having to raise those COVID reserves. So we were challenged with it. We had to do it on one of ours. Luckily, this last deal, they didn't ask for them. So those are two good examples of where a company would this come in. And then also, of course, if you're going to just have one person to deal with versus to work with on a deal versus having to get like 40 people and work with a whole bunch of people, that could be very useful as well, especially if you have a lot of stuff going on, or the property is it's unique. It's a unique business plan. It's a unique situation with the deal. Like, say, example, we're looking into like a low income housing thing, like a LIHTC type thing, like that side of the world. And that might be something where we would call, a prep equity firm versus bringing it to investors, just because of the situation around that deal it's a little unique from our normal value add business model. So they might be able to fit in a little bit better piece in that puzzle. Yeah, good stuff.
Oh, and then the other benefit too is prep equity tends to require a lower IRR, like between 12 and 14. Whereas common equity, typically people are expecting 16 to 18.
Yep.
So if you know that you got a home run deal, you can preserve some of the IRR for yourself if you go with prep equity for at least part of the capital stack, because it's a lower return overall.
Yep. Good stuff. Thanks, Duke. Duke sent me his book as a birthday present. I read it. And you can see the book isn't that big. It's like 100 pages. So usually when you get these books, they're usually part of some kind of funnel, right? Because a lot of people have them, and a lot of people in real estate, and you kind of know what you're going to expect. This book here was absolutely packed, like page, cover to cover, with an incredibly dense amount of knowledge and in value. So I just had a couple points. Did we put those in, or? Yeah. So pretty much starts off with underwriting basics or deal basics. Like this is, really high level stuff. And it's a drill down type book of like really high level, keep it simple, and just understand what the different positions are in a syndication, what a syndication is, what to look for in sponsors and things like that. Some red flags of sponsorship structures. But his niche is definitely being an underwriting expert. One of the best out right now that does that offers value and offers their services and education, stuff like that. I don't know if he does education, but he'll come out and do like meetups and conferences and things like that. So bunch of content on him on YouTube too, so check that out. Then he goes into underwriting. He built a underwriting model, and it's actually the underwriting model we use in our deals. Duke is has a preference toward his model versus the 5 other ones that we have in our folders. This is his underwriting model is the one that we keep coming back to. It's very well put together. So he goes into like, here's what you need to underwrite. And that's mainly, again, very high level stuff. It's like, things to look for, T12 rent rolls, where to put everything, why you're putting things in there. And that's like the first half of the book. And then it goes into the things that I wanted to know, and I was really surprised at how much depth he gets into with when you're making assumptions about your underwriting, because you put in the current performance. Okay, here's how much maintenance is, here much insurance, taxes, and whatnot, all those expenses, and then you put in your pro forma, and then you kind of build out your assumptions, like what do you think you're going to be able to achieve over the next 5 years. So his assumptions guidance in here when it comes to like how much reserves to have, how the interest reserves, again, is a huge one, and that's what we talked about. The prep equity is a huge one. Always a big battle of, do the interest reserves go above the line, below the line? Replacement reserves, do they go above the line, do they go below the line? The NOI line is what I'm talking about. And he doesn't just say why, what he does, which is above the line, so he accounts for those things, but also why. And an example being, he usually does replacement reserves above that line, which is going to deflate your NOI. And so a lot of people don't do that because it makes your property essentially less valuable. But he does it to add an extra layer of protection in there, like another layer of being conservative on your underwriting, just add more safety into your underwriting. So it definitely made a lot of sense of why he does it that way. Then he goes into things that I've never even heard of, like when you're talking about financing, looking at what, paying closer attention to what financing the seller has. And this is something when you're doing bigger commercial properties, and you're doing single families and the duplex stuff, you really don't care because you're just going to get your own financing, and there really is no stipulations. But once you're doing larger deals like agency type of debt, there could be a lot of strings attached with like CMBS loans and things like that, HUD loans and whatnot. And you really want to become an expert of asking the questions of what kind of debt they have, because there might be strings attached to it that you might not know about until like the 11th hour or something, like, or you might get like 1 or 2 months in and realize that there's going to be some huge like assumption that you have to do on a deal, and you're going to have to, they're essentially going to force you to accept, take over a loan or something like that, or pay some kind of defeasance that might torpedo the deal. So being able to ask those questions up front will really help you out. And that's just something, again, that I haven't really heard a lot of other people talk about. Other big things like going, when you're talking about your annual rent increases and your burn rates for your loss to lease. And these are things that a lot of people just have canned inputs for their underwriting models. Like, okay, we're going to put rent growth at 2. We're going to put expense growth at 3. We're going to put our loss to lease or our stabilization period, whatever, at 12 months. And that's going to have a burn on your loss to lease. And they're just inputting these data fields into the Excel, and they really don't understand why they're doing it. It's just kind of just like programmed in, and they're just going to put it in, and hopefully the output is going to be, a 16% IRR, but they don't understand really why they're doing it. And in that chapter here, for the underwriting assumptions of when you're putting these in, he does a really good job of breaking down, this is why we do a going in vacancy rate of X. So this is what you're going to look at. When you're doing annual increases, look at this, because annual rent increase is an incredibly sensitive input, right? And that's another thing that a lot of other people don't talk about when it comes to underwriting, is not all levers are the same length, I guess would be a good analogy. And you've heard me talk about that before when I talk about underwriting. It's all just levers, right? I'm just, okay, I can do, pull this lever down a little bit and I get, a boost over here, or maybe I have to lift this one up, so maybe I can pull that one down a little bit, like LTV or something like that, or CapEx, or the rent increases, things like that. But what he really helps you understand is that not all of those levers are the same length, meaning, a little adjustment in rent increase is going to have an exponential result in your deal and your pro forma of what your returns are for your investment. For example, going from like a 2% rent increase assumption to a 3% rent increase assumption doesn't sound like anything. You're talking about 1%. But that could be the difference of going from like a 13% IRR in like a mediocre deal to like a 17% IRR, and you're like, I'm a genius, I found the best deal in the world, right? And that's what it really helps you break down, is making sure you're understanding when you're doing underwriting, when you're doing financial modeling, that you're understanding what you're putting in, why you're putting in there, and what the cause and effect of just tiny little changes are. Because, for example, a deeper analysis or example of that is, say I do that 1% rent bump in rent growth. Doesn't sound like a lot, but if I say I'm going to do a 50% or $50,000 reduction in closing costs, you're like, oh wow, that's going to be huge. Really, a $50,000 on a $2 million deal, $50,000 reduction in closing costs is barely going to move the needle. It'll be like 0.02%, but a 1% rent bump in rent growth, compounded over 5 years, is going to have a huge result. So those are things that you want to pay very close attention to when you're doing your assumptions. And that was one of the biggest takeaways I have here. Even again, your exit assumptions here. So that's a huge one that we're seeing a lot. Me and Duke are seeing these a lot, because we're, we get OMs and things like that from a lot of other syndicators as well. And a lot of people are doing, we call it a terminal cap rate or reversion cap rate. And they're doing like, we bought it at a 6 and we're going to sell it at like a 5.5. Right. So what that means, the context of that is, they're going to buy it at, now, what condition is it in now? And they're like guaranteeing on their underwriting that they're going to sell it in a better market than it is today, for in like better condition, better financials. Like they're guaranteeing that they're going to, or they're trying to guarantee that they're going to, sell it for more money, or the market's going to be the same or better than it is now. And that's not the case. And that's very, very poor underwriting practice. So the way you add protection is, say you buy it at a 6, you want your terminal cap rate, or your reversion cap rate, to be like a 7. So on your underwriting, you're planning on the market being worse. You're planning on your property being worse valuable than it is in five years from now than it is today. Because, it's 5 years older, 5 years more, use out of it. Plus, you can't see the future. So let's just plan on the future being worse than it is now. The market, I mean. So going into your exit assumptions of, okay, what is a good terminal cap rate? Because that is an absolute huge lever. Just going from like a 6 to 6.5 doesn't sound like much, but you do that on a 20 unit, 30 unit, 40 unit deal, $1, $2, $3, $4 million deal. It's going to have, you're going to be like, I'm making $1 million, right? Because I put my terminal cap rate down, 1.5 or 150 basis points, and it's going to look like, the best deal of the century. So you really want to be conscious of what you're putting in and why you're putting in there, and what the cause and effect of moving those tiny little levers in a financial model is. So that was huge. What I took out of that, probably the biggest one was the assumptions. Other ones, when it comes to finding your comps, and that's really hard, especially if you're doing off-market deals, things like that. If you're doing deals where there's not a lot trading, finding comps. I know there's a lot of agents on here that knows, what I'm talking about. There's obviously a lot more single-family houses than a 40-unit property, C-class property built in 1974, garden style, whatever, in this town, right? So comps are really important. He's like, make sure you're getting the right comps. He has some good comments on that. And it's not usually the sale comps that usually catch investors up. It's usually the rental comps. The comps that they're going to use to project their pro forma rents is usually what catch people, investors up with, because they're usually over project their comps, because they're not looking at properties apples to apples, right? They're looking at, okay, I have a 40 unit here, or my 2-bedroom units here are going for 700, and the ones across the street are going for 800. That means I can get a $100 rent bump when I take over this property with some paint and some, brushed nickel fixtures. And that's not the case, because the property across the street might be, 15 years newer. It might have covered parking. It might have a pool. It might have things like water's included, right? They didn't even check, they might not even check to see what utilities are included. So the property across the street might be an all-in 800, where, the base rent might be 700, but then they have, pet fees included, parking's, reserve parking's included, and, use of the pool and water's included, and trash is included for 800. So if you don't check that stuff, you don't do your due diligence of making sure you're not just getting a comp based off of, a 2-bedroom, 800 square foot unit, and you're going to apartments.com and just like, okay, all these ones over here are getting 850 and I'm getting 700. I'm going to be rich, right? There's probably a reason, and there's probably a reason where, they're not getting it, like they're just bad managers and that's the opportunity. But there's probably just as good of a reason. Those properties are apples to oranges. They're probably a different product, probably a different vintage, probably offer different amenities. Definitely look at the utilities. How are the utilities split? That's one of the biggest things we see, is that some properties that we're trying to use as a comp, we dive into it deeper, and that comp has, trash and water and all that stuff included, and ours doesn't. So it's not really the same comp. We have to discount our pro forma rents back because of that. Like, we'll never be able to achieve that rent. We'll always be under that, usually, because of that. Or things like wash and dryers. If the property across the street has wash and dryers in unit, you ain't competing with that with your coin-op laundry room, right? You're gonna have to fix that, or just be understandable that you're gonna be following their price, their pricing. So those are big ones. Talk about that. I think there was one more over here. Evaluating the results. So he does a good thing on one of the things, like just understanding what IRR is. That IRR is a number that everybody throws around, like, trying to get that 18% or 15+% IRR. I am a big advocate of IRR as just one metric of a few that an investor needs to know about. And we have our KPIs internally of we look for IRR, cash on cash, yield on cost is the one I'm going to talk about in a second here, and things like that, AAR, and for us, one of the most important ones is equity multiple. So a lot of people get caught up in just getting the best IRR, and the IRR has flaws in it because, it takes into account time value money, but it doesn't take into account risk and the timing of those cash flows. And to me, that's a pretty big flaw, because for example, you can have an IRR of 15, 2 deals IRR 15, and one of them can provide zero cash flow for 4 years, provide cash flow on year 5, and then a huge windfall sale at the end. huge sale at the end, and they'll be like, okay, it's 15% IRR. Or you can have deal 2, which is a 15% IRR, which has moderate cash flows, starting in year 2, 3, 4, 5, and then has a modest bump in the windfall at the end of the sale on the upside, and they're both 15. But which one is riskier? The first one, right? Because you're betting, you're putting all your chips on hoping that the market appreciates, or that the operator was able to force the appreciation of this deal and get that big sale at the end, essentially like flipping a property. Or the second one is, it's the same 15% IR, but it carries a low risk adjusted return, or a lower risk profile. I mean, because the cash flows come on sooner. The sooner investors get their money back, the lower their risk profile is, because their cost basis is progressively getting lower and lower into a deal. So that was a big point in the book of just making sure you don't forget that the IRR is not the end all be all. And then the last thing was absolutely the stress tables. If you're not, and this is one of the best things I think me and Duke do when we get together, is we build a model, or he builds a model. Duke will build the model, spend hours and hours and hours building a pro forma, and then we get on a call and we just poke holes through it of like, what are all the ways that this thing can go bad? What are all the ways that we can lose all of our money and this is a big bust? And we just go through and poke holes through everything: the rent growth, the pro forma rents, the OpEx ratio, all these things that we plan on doing. We go through and stress it out and figure out all the ways it can go wrong, and where's all of our break-even points. Where do we start losing, equity? And are we willing to accept that risk? How bad does the market have to get in order for us to call the deal off? And if it's like way out there, like we're buying at a 6 cap or something like that, and it has to go all the way to like a 10 cap before we start breaking even for market, then that's a pretty good spread. We're going to be okay to go forward. But if like we're buying at a 6 and our break even, and it goes to like a 6.5 or a 7 before we start losing money, that's probably a huge risky deal. That something's there. Either we messed up a decimal point somewhere, or that deal is going to be really thin and too risky for us. So the stress tables in there, and he talks about why he has them a certain way. Key metrics like break-even occupancy is a huge one. DSCR is obviously a huge one that I think investors often overlook, and things like that. And the yield on cost is another, the big 3 KPIs that I took away during his stress table. So awesome book. Probably went over on that as well. I don't know how much time I was allotted, but I'm sure I blew through it. But again, that was 8 tabs. That was only the information off 8 tabs in this book that I was reading. So definitely tons of knowledge packed into that book. You should get it.